All right, guys, welcome back. We are going to get started here just in a few minutes, or a few seconds, I should say. Make sure we're good to go. Lorna, thank you so much. And let's get started with size matters. Mel, can I hear you just to make sure I can?
You hear me?
All right, awesome. Did you guys have a good 15-minute break? I hope that was enough time for everybody. I think on my next break, I might actually have something to eat. Give me 15 minutes to scarf down something. But let's go ahead and knock this out. So the next thing that I want to be taking a look at, again, guys, size matters. Big footprints in the sand signify the activity of institutions. Focus on the size of the candle that is creating the supplier demand zone. Institutional moves are often marked by larger, more decisive candles. Okay. And this is a really, I love this picture. It's beautiful. Um, it really, it resonates with me. And you'll see that when we get into candles or big candles, we investigate them. So let's go over each line here. Okay. Analysis process. You identify a bigger candle on the screen. That's like our first thing that really sticks out to me, right?
Yeah,
Big,
I
big candle.
I think this is huge,
It
John,
is.
for
Yeah.
people that are trying to, because someone said, "Well, how do we identify an initial candle?" That's not the first step in the process.
Mhm.
First step in the process, right there, John just said, identify the bigger candle.
Right, yeah, and that's going to bring your attention over to that, and then you're going to locate the structure, which I feel like we've done a really good job of going over that. So to answer as well, someone asked, is this the same format as before as far as inside? Yeah, that has not changed, but the inside can be confusing for a lot of people, but it seems like you guys all did a very good job of locating that structure. If no structure, though, go to a lower time frame. So we stopped right before break. We saw that big candle, and it wasn't necessarily an inside and down, but what we do is we investigate. So investigate means to go to different time frames to find what we're looking for. Draw a rectangle zone around that structure. Wait for price to return to that zone. Okay. So again, draw a rectangle zone around that structure and then wait. This is the hard part for a lot of traders is actually waiting for price to arrive to that zone before you take any sort of line of action, meaning before we stay disciplined, before we execute that trade, before anything. Just wait for price to get there. If it's not at a zone, then you're not trading supply and demand. See what I mean? If it's not at a zone and you decide to take a trade, in most cases, that is called speculation. Execution and management. Know your allocation before price gets to that zone. How much money am I going to put on this trade? These are all things that supply and demand allows you to see that before it happens. So um, you should not be rushing to figure these things out because as we've shown you, you can identify these before price gets there. Know your risk. So it's one thing to understand your allocation. Your risk may be different unless you're saying, hey, whatever I pay is going to be my risk. So we're going to understand our risk and our allocation. Then know your profit targets. And we do that by using other supply and demand zones. If we're short, then I need to understand where the demand zones are to the downside, right? Because that's where I'd want to get long. And if I'm short, that's where I'd want to cover my position. So execute the trade. And then here's an important one. And even for me, sometimes I think a lot of us struggle with this. How many of you guys struggle with like letting your trade play out? How many of you take profits when many of you, if you just would have been patient, could have really made your week or your day or maybe even your year? I mean, it just kind of depends, right? So I think that all of us can work on all of these things, but letting your trade play out, that makes a lot of sense to me. So, what does this look like on a chart? So, the big candles equal investigate. So, I see this big candle right here on the oil futures. Okay. The first thing I'm thinking about as prices going up is what? But let me ask you guys a question. If price is moving up this hard, what are you thinking? What is the first things you start thinking, folks?
First thing I think,
Hmm.
where's supply?
Seth, yeah, I'm seeing a lot of people are saying that. BJ, it has to pull back. That's true too. So, BJ, you might be thinking, well, where's the demand zone when it does decide to pull back? So, one thing I'll tell you, right? Janine says, who did that and why? Why would you do such a thing? But honestly, um, I think you could be looking at two different ways. I think a disciplined trader would say, I'm not rushing into this, Mel, because I need to know if there's a supply zone up here. And the other side of that coin is a disciplined trader says, man, instead of getting FOMO'd into this, maybe I should look to see where the demand zone is. Is there a demand zone? Instead of rushing up here at the top, right? Where would I want to get in next? Before rushing in at the top, is there something up and to the left that tells me not to get into this trade? Okay. Now, from the education you've already received today, is there and can you see on this monthly chart an inside and down formation up and to the left? Does anybody see an inside and down formation? That's right, there is. So let's look at it. This is an inside candle. I would expect all of you guys to say yes on that. And this is the down candle. Okay. Now, I know for a fact that many people got bulled up right into these zones. I watched it happen, and it can happen to you, it can happen to me, but identifying structure can help us, not all the time. Okay. Again, remember, this is not 100%, but it will definitely help you to look at the market completely different. This will urge you to take caution before you take that execution. You're going to ask yourself, where is supply and where is demand before every trade? Okay. So when we look closer, okay. So in this, and quite honestly, guys, most of you, what would happen? I kind of gave it away to be fair. What you're waking up to is just this and maybe a couple little candles over here, right? I got this on the monthly just for it to look a little bit more dramatic. But even on the weekly, it was probably insane, or on the daily, it was insane. And so what you're looking at is this candle, and you have no idea where that supply is. So you got to make sure that you're looking at the market from an all time high perspective, or sorry, since inception, and then what you're able to see is structure that's up and to the left. And you know by looking at this, hey, wait a minute, there's an inside and down formation. So news is a catalyst that pushes price to supplier demand. The war caused the catalyst, right? That was the catalyst that pushed price into supply. And then what happens is the way that they disperse this information is through many, many different channels. Social media, whether we're talking Facebook, X, your friends are now telling you what they saw on Instagram or whatever it may be, right? And then obviously the news channels. Okay. And so what this does, it creates a little bit of fear, but also euphoria. So the fear is war. The euphoria, right, is man, I don't want to miss this big move that everyone's talking about. And it led you right into a supply zone. This is the supply zone. This is the reaction or the rejection from that supply zone. And then here is where I shorted and was able to take 600% from the market. Okay. The other thing that some of you traders might have been able to do is identify where that demand is. Okay. Where that demand was in the market. And guess what? The market came back to that level and then pushed up from those demand zones. And look what happened. Okay. So what we have here is a tale of two different stories of the person who is thinking, hey, I want to FOMO into this, but then you figure out where supply is. The person who wants to now get long and understands that, hey, I'm not chasing this. And now they're able to identify even lower. Price gets down there, and then you get a really nice bounce out of this. Okay. So anytime we see a big footprint in the sand, we want to start to lower time frames. And as we lower the time frames, we start to see the structure that Mel and I have taught you so far. Okay. That's all you're doing. Boom. Big candle, go to smaller picture. Okay. Everybody understand that? Now let's talk about imbalance versus the trickle. This is huge because an imbalance in the market means that there was such a big move. Whatever the catalyst was, you create this huge imbalance to the downside. So, what we're going to wait for is for price to push back up towards this imbalance to get short again. Okay. This is the beautiful thing about understanding these levels before price gets there. Now, I'm going to zoom in here for a second, everyone, and I'm going to take a look here. And I want to just go over this real fast. This is a initial candle. Does everybody see these inside candles here and this inside and down formation there? Does everybody see that? Okay, so if we were to create a zone here, it would look like this. Can somebody tell me, was this zone tested? Did somebody come up and get short here? Did it work? Answer is yes. So yes, in this, I have shown you where this supply zone is, but everybody, with the information that you've already been armed with, you could find yourself inside candles and down, create a rectangle, understand what your plan of action is, take your trade, and see the results to the downside. Okay. Over here, I want to show you this example as well. This is the same name, and I want you to notice the difference between this move out right here, and I want you to look at this move down here. Do you guys see the difference of how strong this move out is and how slow this move is? Now I want you to look at the reaction when price moves back up to this zone and it actually breaks through. Okay. Then it breaks down, and then look at this move. Boom. So when we're looking at zones, we can look at imbalance versus a trickle move, and we can gauge that the imbalance, the strong imbalance, is going to be a stronger zone. Now, that is not 100%, but that's okay because later we will teach you how to use a more disciplined approach so that you don't get your face ripped off. Okay. Anything there, Mel, that you want to talk about?
Sorry, had to find
No,
my
it's
mute
okay.
button. No, I mean, I think you covered it as far
Okay.
as trickle versus imbalance. Someone, I think Twins Mom had asked, so you only mark the imbalance zones? And my answer is no, not
Mm-mm.
necessarily.
No.
I will also mark the zones that don't have the trickle, but I can recognize right away the difference. And then, some of this stuff we'll talk about later on in the class, waiting for confirmation, not waiting for confirmation, all those things that have evolved will come into play.
Mm-hmm.
Big
Exactly.
West says unclear on imbalance. Can you clarify further?
Yeah,
And
sure.
Trone says defined imbalance.
Yep. I mean, simply, guys, it just means that price moves so aggressively in one direction that there wasn't enough opposing orders to balance the market. That's what it means. Okay. What it looks like on a chart, let's go ahead and take a look at that. Okay. It looks like this, but I like drawing. Like it just makes sense to me. So we identify this structure, and this is the awesome part. Just follow me on this journey. Okay. We identify, we get pretty decent candle, and then all of a sudden we get an inside candle. And then you start to remember this class that you're in. And then that light starts to go off in your head, and you go, uh-oh, something might be happening here. And then we get this move right here. Now, I want you to imagine this has happened to me, and I'm sure it's happened to a lot of people who trade supply and demand. We have this anticipation. We take a trade, we enter, candle's closed, we have a stop underneath the structure. We'll talk more about why we are different here. We have a stop here, and then you wake up to this. That's called imbalance. The imbalance is created exactly by what I said. It's an aggressive move in one direction that wasn't enough opposing orders to balance. So people wait a lot, right? They wait for something to happen. They wait for Jerome to speak. They wait for the POTUS to say something. They wait to see, what the new SEC is going to talk about or what the data is going to say. And what happens is imbalance is created in the market, and then retail traders, okay, tend to chase at the top. And even institutions, supposedly, right? I don't know. I'm not an institution, but they don't know the information before it happens. So when the move happens so quickly, big money doesn't chase like retail. Okay. They do not chase like retail. These are retail traders that start to attach themselves to this idea. If somebody is trading for JPM or for Goldman Sachs, and they take this information, they want to align themselves with a big order, you will not see these guys buying at the top. So what they're doing is where the imbalance happened in the market, they are looking to get the rest of their orders filled. Mel, you did a video on this. Basically, the idea is if I go out into the market with $100 million, I'm not going to get all my orders filled. The market knows this. Let's say that I got 50 mil that I paid right here, 50 mil. Okay. Retail, that's us, not understanding supply and demand, jump in at the top. Yes, sometimes they get a little bit of continuation, but typically it's right before, unfortunately, they get punched in the face. And then this market comes back to where the bigger money is waiting to fulfill that unbalanced order. Price gets down into there. Typically, those orders are filled, and then we get something like this. We are simply aligning ourselves with this idea in here at a demand zone and also at a supply zone. So I hope that answers your question on imbalance in the market. Did that answer your question there? All right. Moving on, imbalance versus trickle again. This is what it looks like. Okay. Now, for me, this move here, if we zoom in, it says, although price moved out, the out candle simply moved just outside of the initial candle. Okay. So even though it had moved out, it was just basically like the initial candle. So here, inside and up, boop. It's really not much further over this. This isn't like a huge imbalance, if you will. Now look at this move and look at that move. Remember what we were talking about? Big candles, bigger than normal. Look, see that spot? This is the reaction off of that spot right here. Okay. And that is APP, by the way. And this was actually pretty current. So this had come down into a demand zone and then pushed up out of this area here. Okay. All right. Everybody see that? So you have this zone versus this zone.
I don't know, but I see that supply above and I look at that initial I look at that bounce back up into it and I see a
hmm
big old down candle.
Oh, yeah. Yeah, for sure. No, and that's good, Mel. And all of you should be thinking the same exact thing right now. When we go long from a demand zone, you should already understand where your supply zone is. And Mel, we get this question all the time. How do you guys know where your targets are?
The opposite zone.
It's the opposite zone, guys. It's honestly, once you learn this, it's not, we don't overcomplicate things. Okay? That's what I love about supply and demand. Okay? So what you should be doing is always looking up and to the left for that supply. And when things are going down, down and to the left, looking for that demand zone. Okay. So, like in this case, what Mel's saying, if we were to look at this here in this area, we have a supply zone up here. Okay. Could be like this. All right. Are there signs that a zone is about to bust and go the other way?
I I was just answering that. We're going to talk about that
hmm
on the section not all zones are created equal.
hmm What if it's at all time highs? Then what are your targets? We use Fibonacci extensions. Fibonacci extensions. And I actually have a course here at Simpler that you can watch that. It's been pre-recorded. It's amazing. I would take it. Okay. All right. Let's talk about imbalance again. This is near and dear to our hearts. This happened Friday. This was a huge imbalance that's happened. But here's the thing, Mel. Now we know where the supply zone is. So if SMCI ever comes back to this area right here, this is
Uh-huh.
a really nice and balanced area where prices could reject. And I already understand what that total risk is. But again, guys, we're going to show you different ways to create these zones to reduce your risk. Okay. So that's 30 by 31. Imbalance once again. This is gold currency or gold futures. Okay. Notice this huge imbalance, guys. Notice price moved up to this imbalance here, which is supply. Notice we broke down, price went up, and then boop. But one thing you'll notice here is this little area right there, okay, right there, and you are armed with this information now. That is an inside and down, correct? You know how to find an inside and down now, right? So once you anticipated this going down from here, okay, let me ask you guys on this one because I'm going to keep hitting you with some sort of quiz. Okay, 1, 2, and text 3. What candle is your down candle? Okay, so number 3 is your down candle. So if you were watching this closely on this approach, you could have gotten short on candle number 3, and right there around number 1 was your risk on your stop. And again, we'll get into all this a little bit later. But that is your inside and down formation there on this chart. Okay. And once again, let's move on. Okay. And right here, this is probably on gold futures. And I would imagine we probably approach this level again. So put it on your charts. This is a beautiful imbalance area, guys. And it's not that wide. Okay. All right. Right there. 4851 by 4870. It's not very wide. Felicia, you should be looking at this going, man, I hope it goes back up there. Because to me, this is a very low risk trade. And look how it's so imbalanced to the downside, right? I mean, it's absolutely awesome. Now, the other thing is, let's say that price goes up from here. Let's say something happens over the weekend and price actually goes up. Okay. Can somebody tell me, okay, where would you put? Remember, if you're long, you use supply zones, right? Can somebody tell me, does this look about correct for targets? Do you see what I did there? I simply used the inside and down formations that we just taught you. Okay? When you go long, now you understand where your targets are to the upside. You can choose to trim and pull stops up, trim, pull stops up. Boom, look for a bigger short, get out of that position just in case this happens again. Okay? Same thing right there. I love this. And see, what you should start to notice is this is a really simplified process that you don't have to overthink. And some of the new stuff, and I know some of you guys are waiting for some of the new stuff that we've got involved here, you're going to see that these rectangles, they already match up with a lot of different things. It blows my mind every time I do it. I'm like, man, really all you need is the understanding of your risk allocation, how to identify these, and this is your system. Okay. Not all zones are created equal. Fresh versus tested zones. Okay. Fresh zones have not been depleted by repeated trading. Tested zones indicate that many institutional orders have already been filled. Guys, remember, if I was just telling you about Goldman Sachs and JPM, if they got their orders filled and prices went back up, they're probably selling into retail. So when it comes back down there and they already had their orders filled, nobody is there to buy except for the supply and demand trader that maybe is not paying attention to maybe a disciplined approach. Again, Mel will show you that later. They're just going, hey, there's a green zone. I'm going to take it. And then all of a sudden you figure out you're the last one buying. Nobody else is buying that demand anymore. Not everybody wants those green apples and tomatoes. Maybe they're just not as good as they used to be. Okay.
John,
Yes.
BJ has a question before you move on to another slide about
Sure.
the previous slide. They did not see if there as a inside and down, John. So can you zoom in
Yeah.
possibly
Yeah.
to
I can
where that
try.
was?
Are we talking about this one right here?
Yeah.
Yeah, so that is an inside candle. So here is the candle there, okay, right there. And if we were to draw across there, remember this is a solid candle. This is a filled candle, and it did close inside the body. And let me make those green. We got way too much red going on in here. So right there, and this is the body, okay? And the candle is right there. It closed inside, and this is the down move. Now remember, okay, Mel, just in case anyone out there doesn't see it, just like the footprints in the sand, you would come to this 2 hour chart, okay? And you would see these big candles. That's your first thing. You're identifying a big candle, and you're immediately your eyeballs should be drawn to this, going, where are those inside candles?
That's what I was going to say,
Yeah.
John. I
Yeah.
think anyone that is struggling to find the formations, if you change your focus to first look for an imbalance candle, that big footprint
Mhm.
first,
Mhm.
then look to the left of that big candle and see if you have the structure of an inside candle. If you do, great, you can draw your zone right from there. If you do not, then you need to investigate, which means go down to a smaller time frame. So shift your focus from trying to find inside candles or trying to find initial candles. Shift your focus first. Find the imbalance candle.
Hmm. That's right. Right. Exactly. So higher time frame, guys. Where did price make a strong move from? Where did the trend change or accelerate? So, like in this case, look at the acceleration to the downside. Okay. You're looking for institutional footprints. And that's exactly what we're finding here. So, big displacement candle here, little or no overlap. Like overlap as in look how fast the acceleration is here. Holy crap. So you take your eyeballs, you go up, you go up. And again, if you don't see it here, go to a smaller time frame and you'll identify where these zones are. Okay. All right. So again, price reaction from a fresh zone is often much stronger because it hasn't been tested. So if you think about it in theory, if you understand the idea of that imbalance and how it was created and price didn't come back to test it, then you're aligning yourself with that fresh zone. People are going to be pretty happy. Let me ask you a question. If you're this vendor over here, or even if you're the consumer, do you want to buy fresh vegetables from them or do you want to buy the ones that are bruised and spoiled? You know what I mean? And I'm not saying that a used, well, I'm not saying that a used zone is not going to work. And I'm not saying a bruised apple still doesn't taste good. It's probably not my favorite. But most people want to line up with the fresh stuff. Fresh is best. Just remember that. Okay. All right. So, what does a fresh zone look like? Right. So, identify the zone, identify the structure, identify what candle was the exit candle. Make sure no candle has ever come back to that zone since the exit candle left. If no candle has returned, it is fresh. Okay? It is fresh. Now, this is the oil trade that I took. And what's really interesting about it is that I actually closed my puts for 600%. And I did it because we were coming down to a fresh zone, guys. But look, this is an example of a fresh zone that got completely taken out. Okay. And Mel and I were talking about this one earlier, and I really wanted to show this because I say fresh is best. I do want to align myself there. But sometimes it doesn't work. And when it doesn't work, I don't want your feelings to get hurt. But you know what really, really resonates with me with this zone is that Mel's new process would have kept you from even trying to take this zone. And we're going to go deeper into that soon. And I think that is a huge game changer because honestly, in the past, does anybody have any past experience with supply and demand in here? Deepak, right? So I know a lot of you are
There
also with
should be a
trendy.
lot.
Yeah, I know a lot of you are, but how many of you ever try to take a trade right at the top of a zone and put your stop underneath? Right? Many of you have done that for sure.
Me.
Okay. We've all done that, I think. And if you never traded supply and demand, this is kind of a common thing. You have a zone, you look at it, you go, oh, yeah, I got this. Remember, I see green, boom, I go long. And if this happens to you, boy, does it hurt. Matter of fact, in 2025, when we had the crash, and it was a crash, we pulled back a lot. There were things that could have helped me big time so that my gray hair might have stayed darker a little bit longer, and it's because I was not using a confirmation process, which we will go into shortly, okay? Here is a tested zone. Here is a zone that has been tested. Notice that this area right here, this is an inside and up. Okay, I won't quiz you anymore, but that is an inside and up formation. Okay. We actually came back right here. It's kind of hard to see on my chart, but we did come back and test. Okay. Then we came back and tested again. Came back again, came back again. And notice how we just keep getting lower and lower inside this zone. And then you wake up and ES futures decided to puke and down they went. Okay. Again, if we were to come in here and look for confirmation, we might have had a little bit for a little bit of a run. But again, we just bumped up against a little bit of resistance or smaller time frame zones, and we could not get out of this zone. But this is a great example of going, okay, you can only buy spoiled fruit for so long before somebody in the house is like, get that and put it in the trash can. Okay. And that's what this was. They were absolutely finished with us. Time frames matter. Match the zone time frame to your planned trade duration. Match the zone time frame to your planned trade duration. Day traders need shorter time frame zones for quick entries and exits. Swing and positional traders use higher time frame zones. Using the correct zone time frame really improves your trade accuracy. This is a big one. Okay. Mel, you want to go over this one? I'm going to let you go over this one. Is that cool?
Sure. Yeah.
Yeah.
No, I don't mind. Definitely as far as what time frame chart I'm looking at a zone from is going to be determined by the amount of time I want to be in a trade, or vice versa. Let's say that I find an excellent big imbalance candle on a weekly chart and I find the structure on a weekly chart and I'm like, I want to trade this imbalance on the weekly chart. I immediately know, okay, if I get in this trade and the demand zone is from a weekly chart, I need to choose 2, 3, 4, 6 months to expiration to give that zone time to work. Okay, that's why understanding either what how long you want to be in a trade, then you go to that time frame zone or that time frame chart and find your supply and demand. Or if you find the zone first, it's going to tell you what time frame or how long to expiration you need to give yourself. So let's talk about the longer term zones first. John and I both trade quarterly zones. I know that sounds insane, but it happens and we do it repeatedly in the trendy room for our longer term positions. These are leap trades, guys, maybe 6 months, but really a year or longer. I trade my equity positions from quarterly demand zones. Okay, and that's trades I'm going to be in for years. All right. All right, from a monthly zone. These are trades that if you are going long in a monthly demand zone, you need to be plan on being in that trade. I wouldn't say 1 month. I would definitely say more than a month because my stop would be a monthly candle close below the zone. So I'm thinking in the neighborhood of 3 months. Okay. Weekly time frame chart. I would use, hmm, John. I would use that for trades that I plan to be in for a month or longer. I'm sorry. I I don't trade weekly zones, John, for trades for a week because my stop is a candle close, so maybe that's a misprint.
Yeah, it looks like it right here.
Okay.
Yeah, for sure.
Okay. Sorry, I was tripped up there. So let's just, this is a misprint and we will get that fixed. A zone that you find on a weekly time frame chart, your stop is a weekly candle close below the zone. So I would plan to be in a trade for a month or longer. All right. And daily time frame charts, I plan to be in the trade anywhere from a week to a month. All right.
Yeah,
Uh
real quick, Mel, and I will
yep.
say, just so anyone that might be brand new at this does not mean that your results always take that long. I mean, we've taken monthly zones and week zones and got profits in a day. Like I've taken leap trades based off of quarter zones and made 100% like in Netflix in a week.
Oh,
So
yeah.
so just
Yeah.
know that these are like our experience that you have to respect the time frames and understand that this is what we're looking for, but if we get it faster, obviously we take action and so forth, okay?
Oh, yeah, for sure. Shorter term zone. So a 4 hour zone, I'm expecting profits within anywhere from minutes or hour to 8 hours. So maybe, inside of 1 day of trading. 2 hour zones, I'm looking for profits basically same amount of time, anywhere from an hour to 8 hours. For a 30-minute zone, I'm looking for profits anywhere from 5 minutes to an hour or so. And 5 minute zones, guys, those types of scalp trades can happen in less than a minute, and they often happen when we're scalping in less than a minute.
Oh yeah, definitely. And we have so many different trades we've taken in the SPX room where we copy and paste and show you guys how fast our trades are. We've 300 bucks a contract within less than a minute, which is pretty crazy. So yeah, those 5 minute zones, which are like pivots in the market, can really yield money very quickly. And what I like about a Mel most of the time are smaller time frame pivots and zones are less risk. So remember, the higher we go, the bigger the zones are
Mhm.
typically. So
Mhm.
that's why we like to sometimes like you can look at it and go, well, I like that zone, but let me dial it down a little bit, go to a smaller time frame to really reduce my risk. You can do that, but just know that there's different expectations. That's all. Okay.
So, real quick,
Mhm.
Deepak asks, so before you initiate a trade, you determine how long you intend to be in the trade. How does the higher time frame supply and demand zones influence your lower time frame trade? So, Deepak, for me, like if I typically what I do is I see a nice looking demand zone or supply zone on a chart, and I'm looking at what time frame chart that is coming from, and that's going to give me my expiration. Okay. But if I was just searching for some reason and I said, hey, I want to be in a trade for 2 days, let me go to the 2 hour or 4 hour time frame chart. That's how I would do it. And as far as higher time frame, how does it influence your lower time frame trades? You always want to know, Deepak, where those higher time frame supply and demand zones are at. That way you can make sure on your lower time frame charts that you have a target set there at least to trim or move stops to break even.
You're welcome. All right. So what has evolved? Okay. Classic zones versus modern zones. Very, very important. Again, in the placement of the zone, we have reduced risk on average, and it just depends, on average of 30%, which is a really big deal. I mean, that in itself was enough to say, hey, we have to make sure that everybody gets the information on how to place zones. Okay. Modern versus classic zones. Classic zones are typically very wide and based on regular trading hours. Okay. Modern zones, basically what we mean by that is trendy zones, incorporate extended trade in hours price action. Okay. Big difference, guys. Again, we use extended trading hours. So real quick, before I even like move on from here, and because this is recorded, this is a great time to do this. I'm going to bring this in here and just show you real fast. Step one, right here at chart settings. Step two, you're going to identify this section right here. Equities, options, futures, Forex, crypto, whichever ones you trade on. And what we do is this is called an equity chart. Okay. I'm going to click that on. Yep. All day long. You have to trade? Yep, we do. So right here, I'm showing you that. So right in here, show extended, show extended trade in hours session. It says clicked. Highlight extended is off. So what you don't notice on our charts when we have 5, 15, whatever, we always use the extended trading hours. Okay. And again, if you want to, again, step one, click that. And so futures, say you trade futures, same thing right here. These are the check marks you would have in there, guys. Okay. All right. So moving on, let me move this out of the way. Modern zones tuck the proximal line under the imbalance candle. This is huge. Okay, guys? Tucking the line under the candle creates a zone with much tighter risk. Okay,
And,
everybody understand that? Go ahead,
and
Mel.
can I point out for those of you that have been asking throughout this class what has changed? This is a big part of it. Okay, is when we find that imbalance candle, then we are starting our zone at the body of that imbalance candle.
Yep. And we will definitely give you examples here in a second. So modern versus classic zones. In general, like classic supply and demand zones often relied on manual chart reading. Traders look to areas where price historically reverse, usually around peaks and valleys. Modern zones, right? Trendy zones, on the other hand, incorporate additional data layers. For instance, modern traders might use volume profiles to see at what price levels large orders accumulated and so forth. Okay. So again, let's move on. Modern versus classic zones. Okay, modern versus classic zones. Selecting demand zone types based on trend. Mel, talk about this one because you're really good
Yeah.
at explaining this.
All right. So this was a big evolution for John and I, and it happened really over the course of last year, the first quarter of the year. John explained, he's very, very, very transparent, right? He explained that he was layering into trades that he had to set through a lot of pain in the trade because it hadn't broken his stop because he had very wide zones, right? But the overall trend of the market at the time, if you remember the first quarter of last year, it was very similar to the first quarter of this year. In case you don't remember or don't know, it was pretty bearish sentiment. Okay. And John was trading from those classic type zones that were very wide. So, was the zone broken? No. But did he have to set through a lot of pullback inside of the zone? Yes. So, fast forward that to, I believe it was in March of last year, John and I were on a call, and he's like, okay, I feel like you're doing something different during this time because your zones are smaller than what we would typically draw them. So, what has changed?
Mhm.
And I was like, well, I'm watching price action here with the sentiment or the trend being bearish. And I decided rather than trading a wide zone and including like every inside candle before a break or including wicks of candles before, which we would do sometimes. I was like, I am just going absolutely under that big candle move out and using that as a my entry rather than the wide zone. So, with that being said, I will use the wider zone if if I'm trading within the trend. So look at this slide right here. You can see that there is a wide demand zone, but look at how the trend is the candles are moving up and making higher highs and higher lows. So that demand zone is wider, but it's because the trend is bullish. Now look at the counter trend and the idea of using a modern zone, it is more narrow because the price or the current trend is bearish. Okay?
Yes, 100%. And I have modern versus classic zone. So this is demand classic risk, 665 points or $66 in the SPY. Okay. And if you look over here, guys, we have where I place this is in here. I mean, also this, just the modern, or sorry, the classic. Some would use this wick here. So it would start here, and your bottom portion of the zone is here. So I want you to look how wide that is here. Okay. And
Uh,
then go ahead.
Sorry, John.
No, no, you're
Can
good.
because people are asking me to show a couple of examples of how I personally have changed how I draw zones, can I use this example that you're showing and talk
Hmm.
about it
Yep, yep,
as well? Will you zoom in kind
yep.
of on the formation?
How's that
All
look?
right. So, those that have asked this, remember if I was counting one, two, three inside candles and then a break above that mother candle right there, I would have drawn that zone actually higher,
Hmm.
right? But because I learned a valuable lesson over the last several years, my the way I would draw it now will change, and John will show you what that's going to look like.
Yes. So on this one, we would tuck underneath this candle here. Okay. And so your zone would actually be right under here and would come down into this area here. Okay. Now I want to show you another example right here while we're talking about it. I just happen to have this Reddit chart up here, Mel. So our classic, or sorry, yeah, our classic zone would look like, shoot,
All the
probably,
way to
yeah,
that
like
right
all the way
there.
right
Yep,
there.
gap fill. Yep.
And this would be here. Okay. So look at the differences. And right now, the market's pretty bearish, right? You guys all agree? It'd be something like this. Okay. And I'd be like, hey, I'm gonna dollar cost average into this, right? Man, I might have got a little pop right here and felt really good. Then we come in deeper, right? And then we could just keep coming down here. And, it might work out, but like I said, guys, it's very emotional. And if you're not buying enough time, it's just a lot of stress that we don't need to put on ourselves. So the modern zone would tuck underneath this stronger candle. Okay, right under here. Is this where you'd place it, Mel? Right in there? About right
Yeah,
there?
for sure.
Yep, yep.
Yep,
So we're
that's
gonna go right
exactly
there.
how I would place it. Yep.
Yep. And we're gonna come right there. So I want you to look at the difference. Let's just duplicate this and just look at this difference here. Okay, right there. So we're going from 160 by 77, which is huge, to 109, and so you just say 110 by 77 and a half. Big difference. The overall trend is down. We have lower highs, right? And we are moving to the downside. Now, what Mel was explaining is if the trend was up and we were actually in a strong market right now, we could use this wider zone because our expectation in a strong bull market is that they are going to buy up this stock here at this level. But since we're in a down pressure market, we are going with the more modern view here. Okay. Now, one thing that I would say is that when we're looking over here to the left, we can identify that, hey, this is in a classic zone. So, one thing that I've taught you today, what could we be looking for? Let's say that we don't come down to this lower zone here. Okay. What is one thing that we could? I'm going to give you here's your next quiz. Okay. Make sure you guys are awake here. It starts with an A, ends with an what, D or an N. Let's just say it starts with A. What can we be looking for? Anticipation. So if for some reason we don't come down to here, but let's say that this candle goes up in here and it's an inside candle, and then all of a sudden we get an inside and up formation, now we're anticipating that we're getting a demand zone. Okay. So this is something to understand. I love this because I love the less risk here, and in this market, Mel, has been working over and over and over. Like it's just much better instead of you guys getting hammered on a bigger, wider zone. Okay. So in this one, what we're doing is we're tucking up underneath here, just like that. And the reason why, this is the best way I can explain it, this is where the most pressure or the most imbalance is coming out. And I want to be right underneath this looking for that big move out. Okay.
John, can
Yeah.
I real quick just
Hmm.
share my screen
Sure.
because we had several questions about we see, like demonstrating exactly how we would uh, set the zone.
Hmm.
All right.
Hmm.
So I'm just going to go to a live screen real quick. And Twins Mom, this should answer your question as well. So here is that Reddit chart, no drawings on it. This is real time, real life. All right. All right. Big West, I'm going to show you and anyone else. I saw several people asking exactly how we draw the zones. First thing, you want to find the top of the zone. In this example, here's your inside candles, and here is your candle up. That is the top of the demand zone. I tucked it right, the proximal line, right under the up candle, right? The exit candle. The bottom of the zone is the lowest point of the candle formation. And we like to go slightly below there. So not right to the penny, but slightly below. So in this example, this is how we would draw that modern zone. All right. Any questions before I take this and show how I or John may have previously drawn this zone since we would you're saying would we take this above the zone for anticipation? No, and I don't think John has said that. So I set an alert at the zone. What he is saying is if this formation was in the process of happening right now and you were catching this as it was happening, in anticipation would be you go long above the body, right? Boom, go long. But we wait for price to come back to the zone before executing the trade. All right. So the classic zone. Let's talk about the classic zone. Everybody understands this is the new way I would draw this zone. Given the current market conditions, we all agree that we're downtrending right now. All right. That's the modern. Now the classic. Number one, if you consider this the inside candle, here's your body. This candle, this candle, this candle, and this candle all closed inside. Everyone agree of the initial candle, not using the anticipation process. Everyone agree. All right. Then, for that reason, this would be the classic zone drawn in real time right here. So, look at the difference in risk.
It's huge.
Yeah, it is about 59 more dollars of risk. And let me tell you, as an options trader, I don't care how much time you have, when you're sitting in a pullback of an additional $59, you're hurting. All right?
Yeah, you are hurting, guys, because I was hurting last year.
Yeah.
I mean, honestly, like I was in positions that worked for me, but they were hurting, you know. And that's what we're trying to do is reduce that hurt, if you will. And this is one way you do it is by reducing that risk. I mean, honestly, wouldn't you rather get stopped out for like, 13 on a long, trade than a 56 wide? It's just it makes such a huge difference. And that's not even combined what I was telling Mel. On average, I went back and looked into the math on this. We're reducing risk on an average of 30%. That's probably way more than 30% right there, Mel.
Mm-hmm.
That's probably more like 50%.
That was 50, yes.
Right, and that's not even combining Melissa's disciplined approach with confirmation. So, I mean, those probabilities exponentially go up if you take both of those and combine them and say, hey, one, we're doing this in this trending market to the downside. We're going to reduce that demand zone. Then we're going to wait for confirmation. And then that confirmation could save us huge. Even though we've reduced the risk, Mel, maybe it doesn't confirm,
Yep.
right? So this is just one key to the aspect that is different.
All right.
When do you use the classic?
Here's I'll answer that one, but they asked for a supply zone
Okay, yeah,
example.
yeah.
So here is the modern supply zone example. You have an inside candle and a down candle. This on a monthly chart, apparently, right now. But
Mhm.
regardless, it doesn't matter. So a classic way for us to draw this would have been using this wick, right? The entire structure here. And you could have drawn this zone this wide rather than this wide. That's an example. So a supply zone, the top of the zone is going to be the high or slightly above of the three candle formation. And then the proximal line or the bottom of the supply zone, I am tucking under the big downed candle. Okay. Sorry, John.
No, that looks great. And which that makes a big difference right there, especially when trading SPX, right? Or if we're looking at ES futures. So once again, she's tucking on the biggest move out there, and that is reducing the risk right there on top of that candle.
Right there.
Hmm.
So I didn't realize I was on a monthly. I can probably find a better example here on a weekly too. So in the past, right? Now, someone asked, when would we use a classic zone? And that's a great question. So the modern zone here would just be we use the top, right? Here you have an inside candle and a down, right? And this would be if we were in a uptrending market, this is what the zone would look like. But since we're in a downtrending market, it makes more sense to use the classic, the wider
Mm-hmm.
zone, right? Everyone understand. The market is downtrending. Let's then use the classic, the wider zone, because if we're shorting a pop in a downtrending market, I want my entry to come quicker rather than later. And vice versa, if we're going long in a downtrending market, I want my entry to come later rather than earlier. Does that
Mm-hmm.
make sense?
Mm-hmm. It does to me. How about for you guys? Do you understand that? David, you had a great, does this mean we use the modern version in a bear market and the classic in a bull market, or do we
Not
use the modern?
necessarily.
Yeah, not necessarily. So right now we're trending down. So what she's saying is we do a wider zone because we want to be proactive in
For
that.
the short,
Yeah, for the short.
because that would be the trend going with the trend. We would use the wider zone going with the trend, which right now is to the downside. We would use the more narrow zone to buy a dip because it is against the current trend.
Mhm, mhm.
There you go. Seth says, yes, when with trend, more risk, counter trend, less risk.
Right. Exactly. Yep, Seth, good explanation. And it is different, twins mom, so that it's okay if it feels a little confusing at the moment, but it is different. That's why we're having this class, is because this is the smarter way to do this.
So, twins mom, you will. So, I've actually been drawing the zones to go along with this way for my zones for a year now, a solid year now. This is how I would draw my zones. And I'll show you to show you that this is how I've been drawing them, how I just explained to you, right? There. And I don't know if I've changed the weekly zone, but there's the supply zone. Notice I'm on the default chart, twins mom. So you probably didn't even realize the difference. But look, do you see it? That's my weekly chart that I've been given to you for quite a while. Okay. And it is exactly what I just explained. I'm making this a wider zone because it is with the current trend, right? Wider zone because it's with the current trend. Now look at how I just showed you, and you said, I don't understand. That's how I would have drawn it. Well, then you would have been drawn it correctly. You're getting a lot of questions, John, about the trendy edges and the structure finder, classic or modern.
It's just showing you the structure. It's not going to paint a zone for you. So you have to be the one that when you see the structure, then you have to paint the zone, right? So when I say paint the zone, you're going to create the zone. The structure is just to show it to you. Let me share my screen real
Yep.
quick and come back over here, guys. And we had a question about Tesla. So I'm going to do the same thing. All right. And so let's just say I'll point out what you guys just asked about the structural thing. Let's say that you find structure right here on that new indicator. It's going to be up to you to identify whether or not what trend are we in. So let's start there, Mel. What trend is Tesla in? And this is a question from one of you all to look at Tesla. So which way are we trending right now in Tesla? Down, right? Everybody would say it's bearish, correct? Now let's do the next. What's the next quiz question? If it's down, what are we doing? Classic or are we doing modern for the demand zone? Mel, you want to answer that?
We're doing
I know you
modern to go long the
because
trend is bearish
the trend is
and a demand zone is bullish, guys.
right,
You're bullish in a demand zone, and that is counter the current trend. So we're drawing a modern zone,
right.
less risk.
And one thing that I want to make sure that maybe if somebody is brand new here understands is that remember when we were finding the initial candle, and then every candle that's within here, guys, is part of what we call formation. So I'm trying to think back, like very, very, the fundamentals of this. This is you take all this into consideration is the formation or the structure. So for example, follow along with me here. Okay. So we have this initial candle, and this is an inside candle, and this is an up candle. Okay. This is a initial candle. This is an inside candle. This is an inside candle. This is an inside candle. This is an up candle. Everybody, yes or no? So once again, let's do the lines right here. This is the entire structure of a zone. Everybody got that? Right there. So I'm going to go over it one more time. Okay. Initial. 1, 2, 3, boom. Okay. This right here, this is going to be a quiz question. We're going to do two different zones here. Okay. Boom. We're going to make this one, we're just going to make it super dark green. Okay. Or wait, that's not really green either. Goodness gracious. Let's go with that one. Okay. And then we are going to go with just like that. This is the classic, or is that the modern? Classic. Wider is classic. Modern slash trendy. I kind of like the word just trendy better because it's, I get a little confused between modern and classic, but I get it. So classic is wider. This is modern. Notice how I tucked price up underneath the bigger candle out. Can I get a yes or no? Do you notice how on the modern we tucked under the big candle out? As a reminder, the market is down. Tesla is trending down. So we are resorting to less risk in a zone. If Tesla was trending up, would we use the modern or would we use, sorry, the classic or would we use the modern? If Tesla was trending up, which one would we use? Classic. If it's trending up, okay? Let me draw this for you one more time. See, what happens is when things are trending up, bulls love to buy, right? And they love to buy their zone. So what we're going to do is we're going to be okay with a wider zone because man, it's a beautiful year and people are having fun and boom, they love to buy. When things start trending to the downside, okay, people are scared. They really are. Like, uh-oh, I've already been burned a couple times. So what we're going to do instead of something like this, we are going to go, I'm only getting in at this really big imbalance candle that's down here. So when price makes its way through the classic zone and gets to the modern zone, that's when we take action. And I actually had a chart. I thought I had one on here. There we go. I can't make this up. I had to put this on here today. I said, Mel, this actually really shows like something near and dear to our hearts. This is ES futures on Friday. This was my zone that I've been using. Okay. And to be fair, look how well it worked. This is in the room, guys. So look how well it worked. It was a tested zone. And notice that the classic zone, guys, 6590 by 6520. That's 70 points of risk, or about $7 in the SPY. Okay? 70 points right here, guys. This right here is only 26 points. This is more than 50%, way more than 50% of reduction in risk. Look at the reaction off of this zone. The person who went long here at 65.90, this is where gray hair and possibly even no hair happens. But in the modern zone, here, this is a lot more tolerable. It's less risk. We know it's a demand zone, but we also understand that the overall sentiment is bearish. Okay? Yeah, no problem. Let's go over here, Tim. Let's go to the ES futures. Okay. We're going to follow this across. Make sure I have enough time in here. Should be good with this. I'll just put a year on here just in case, though.
John, I'll help you out. That 60, the top is November 20th, I
Yep,
think.
I found it right here.
Okay.
Yep. So right here, Tim, right in there. See that? So let's take that out. Sorry. So right underneath this big move out right here. Okay. Pretty cool, right? So if you guys have been wondering, if any of you have been wondering how long do zones last? They last since inception, but once they're invalidated, right? And we no longer use them anymore. Okay. When are they invalidated? We'll get to that in a few minutes when we talk about our stops and so forth. Okay. All right. Mel, how do you think we feel with modern versus classic? Do you guys need to see one more example? How do you feel? Okay. They want to
I
see more
think they
examples.
probably need to see more examples.
Okay. Let's go ahead. And we can pick anything. What do you guys feel like? I say that. Let's pull up Apple. Let's go to a little bit higher time frame. Let's go into the weekly here. I'm so glad that, by the way, I'm so glad that this is working because, sometimes Thinkorswim doesn't work on Saturdays. Okay.
Oh, I know. I thought about that as well.
Let's go to a clear drawing set. Nope. Drawings, create new drawing set. Let's go here. And let's go class. I'll just name it class, create. Okay. All right. So first of all, let's take a journey. Current price is here. We're going to work down and go to the left. Okay. For a zone. All right. And just so we understand, this is actually a zone right here, Mel. Right there. Okay. You see that? We tracking? Okay. This is actually a zone that we tested before. And then we're testing again. Everybody see that? Initial, inside, up. Okay. All right.
Yeah, but just to be clear, John,
I'm
will
gonna go
you
to
draw
amazing.
the zone like
Yeah, yeah, yeah.
actually how you
Yeah,
would
yeah.
draw it?
Yep, yep. Well, let's do both, okay? So this would be a little bit under. So anytime I draw a zone, guys, I am not surgical about it. unless we're talking futures or something. If I'm doing options, I give it a little bit, like Melissa was saying. We're not gonna like I don't have to touch this thing. I come up, I come down just a little bit, and I go up above. Okay, so classic. All right, that's old school, nice and wide. All right, it's gonna be about right there. Okay, this is our classic zone. Okay, right there. Price came out. It came back and tested, bounced for a few minutes, came all the way back to the downside, whatever. Here it is again. Okay. Modern. Where do you want to tuck this under, Mel? I would do it right underneath this guy because we have a gap in here. So now watch this. It's going to come down to about right there. So the zone is going to be about this thick here. Okay. Right in here. Nice push. I'm taking in the gap. I could also go right here to the gap. I'm going to go underneath this though. Okay. And this is going to be 249 by 242. And you can see, okay, in these conditions, instead of going under at 259 and taking the damage, getting in here was the smarter move. Does everyone see that? Okay. Yeah, so the gap is right here. So we can go right there as well if you guys want it right here. Okay, so if you take into consideration the gap and we fill that in, that means this candle actually looks like this. So this is our strongest one out. So we're going to put that right there. Okay, so even here, 252 by 242, that's $10. Okay, right here. And if we come up here, 259 by 242, oof, that's a big one, $17. Okay, just like that. So risk of 17 versus 10. Okay, now let's just do a brand new one again. I'm going to put this over here. I'm going to get these lines out of the way. Okay. Now let's go over here. Let's take a journey. We're going to go over here. Okay, right here. Question for you all. Is that your inside candle? Yes or no? That one right there. Is that an inside candle? All right, cool. We are tracking. Classic. I'm going to ask yes or no. Is that the classic zone? Yes or no? Awesome. If you said no, it's okay. The whole formation right here, inside and up, it involves all three of those. Okay? Yes. Let's do some math here. 241 by 225. What is that? 15, 16? Let's just say 16. Close enough, I think. Right? Okay, cool. This is classic. Modern. Underneath this candle? Yes or no? Let me pull this over. It might be a little confusing right there. Yes? Okay, 236 by 25. We reduce our risk here at 11. Okay, about $5. This is a big deal. In this scenario on Apple, would we use modern or classic? And why would we use modern? Because of trend. So overall trend is down, higher lows, sorry, lower highs. Okay, and we're about to maybe potentially go here. So if anybody's been interested in Apple, there is a potential here between 236 and 225. Mel, do you like that zone?
I do like that zone.
Yeah, this zone
Hey,
looks great. Yeah,
after we finish this one, is there a way we can take like a 5-10 minute break?
I don't know. Deepak said no more breaks. No, I'm just kidding. He said no more breaks. So this is a modern. zone. And again, the classic zone's a lot wider. Okay. One last question for you guys. Let me see what the next okay. Okay. Yep. Cool. I like this. All right. So let's go over here. I'm going to ask you this because this kind of ties into what we've been learning. What do we do here? Big West catching on fast. Guys, big footprint, right? All right. Big footprint. Or, or, well, yeah, let's go. So this is how you go before I go to break. We're going to identify with this big circle here. Okay. This is, if you will, this is your magnifier, if you want. Okay. This is your magnifier. So that when we reduce the time frame, let's go to a daily. We go back to try and find our magnifier is a big red circle. And that's what we're looking for on this one. Let's go to, I said class. There we go. There it is right there. What do you guys see? All right. Nice. Imbalance, double inside and ups. Looking good. 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 You guys are doing awesome. Now watch this. We're going to do one more for the road. All right. We're going to come up here. I'm going to take this structure. Okay. Okay. I mean, just to be nice to the classic version, I could go like this. Okay. Classic, classic, 210 by 201, 209. You ready? Modern, $4. Classic, $9. Everybody see that? Classic, boom. Okay. Now, to fill in this gap, I can make this thing even thinner, guys. Okay. So Big says, I like the modern. I'm an anticipation kind of guy. Yeah. So again, guys, if the market's trending, we'll go with classic. If the market's not trending, we're going with modern to reduce our risk and not to try and catch a falling knife, or in the event that we're trying to go short and the market was super bullish, as Mel would say, get run over by a moving train. One of the two. Okay. And again, guys, so just to ensure that we get through the class, at the end of this, we'll take more Q&A, but let's stop it right there. We'll do, how long do you want to do, Mel?
I'd say 5 minutes should be good,
I think five
unless,
minutes is good
yeah,
too.
yeah.
Is that okay with you guys? 5 minutes instead of 15? Janet, we got you. Don't worry. Okay, let's do 5. So we're going to come in here. Let me set my timer real quick. Let's go to zoom it and go to my break.